Most of you know me as the real estate guy, the landlord, the cash flow investor, the buy assets, not liabilities finance shark. But today I'm going to show you something I've never broken down publicly before, my dividend income portfolio, and how it quietly pays me $2,400 per month on top of my rental income. Because here's the truth I've been hiding from you. My rental properties aren't my only cash flow source. Not even close. I've been building a second cash flow engine behind the scenes, one that complements real estate, smooths out my risk, and gives me liquidity without sacrificing returns. I'm going to show you my exact dividend holdings, my monthly and annual dividend totals, the yields, the allocations, and the philosophy behind why I picked each one. And then I'll show you how this compares directly to my rental cash flow. By the end of this video, you'll understand not just what I invest in, but why I structure my cash flow life the way I do. Because true financial freedom doesn't come from one asset. It comes from multiple income streams working together. People always ask me, if real estate is so good, why buy dividend stocks? The answer is simple. Real estate gives you big tax benefits, leverage, appreciation, forced equity, depreciation, control, and predictable income. But it does not give you liquidity, instant diversification, completely passive income, or market hedging outside your local real estate environment. Dividend investing fills those gaps perfectly. Real estate is the engine. Dividends are the suspension system. One produces massive power, the other smooths out the ride. And in my case, that smoothing effect equals $2,400 per month, paid to me whether I'm on vacation, sleeping, or at the gym. And here's the key. I built this dividend stream with the same philosophy I use for real estate. Cash flow first, growth second. The same way I buy properties that cash flow day one, I buy dividend stocks that pay me day one. No gambling, no hype, cash flow only. My dividend portfolio is built around 4 categories: high-yield cash flow holdings, dividend growth stocks, REITs, and low-volatility covered call ETFs. Each one plays a different role. Some maximize cash flow. Some maximize long-term growth. Some protect the downside. Some take advantage of volatility instead of suffering from it. Together, they form a balanced cash flow machine. The first category is high-yield cash flow holdings. This is the backbone of the portfolio. It makes up about 40% of the total and produces nearly 60% of the income. These include high-yield ETFs like JEPI and JEPQ, utilities with stable cash flow, business development companies, and preferred shares that act like bond replacements. Yields in this category range from 6 to 10%. These positions generate around $1,300 to $1,400 per month. The income is stable, predictable, and continues even when markets dip. The second category is dividend growth stocks. These are blue-chip companies that raise their dividends year after year. PepsiCo, Microsoft, Johnson & Johnson, Home Depot, Visa, Costco, Broadcom. They don't pay huge yields, usually 1 to 3%, but they are durable. They grow their dividends through recessions. This bucket makes up 30% of the portfolio and pays about $400 per month. The real magic is yield on cost. A 1.5% yield today becomes a 6% yield later if the dividend grows consistently. This is how wealthy families build quiet cash flow machines that last generations. The third category is REITs, real estate without the tenant headaches. My REIT bucket pays around $350 per month and includes industrial REITs, cell tower REITs, data center REITs, multifamily REITs, healthcare REITs, and net lease REITs. These pay yields between 3 and 8%, but the real power is diversification. When my physical rentals have repairs, vacancies, or CapEx, my REITs keep paying. And when REITs dip because of interest rates, my physical rentals don't care. Tenants still pay rent. Real estate diversifies real estate. The fourth category is covered call ETFs. This bucket is pure income enhancement. Think XYLD, QYLD, RYLD, JEPI, DIVO, other income-enhanced ETFs. Yields range from 7 to 12%. I don't rely on them for long-term growth, but they are excellent for boosting monthly cash flow. This category pays me around $300 per month. Used correctly, covered call ETFs are the dividend investor's cheat code. Now let's look at the split-screen comparison between my rental cash flow and my dividend cash flow. My rental properties produce real monthly cash flow after every expense: mortgage, taxes, insurance, maintenance, management, vacancies, CapEx, everything. Even after all those expenses, the properties still cash flow positively and build equity through principal paydown. That's the key. Real estate produces cash flow and forced appreciation. Dividends produce cash flow only, no leverage. But dividends also never call you at midnight, never need a roof, never need a plumber, and never file an eviction. Dividends require zero management. Real estate requires execution. Dividends don't scale fast. Real estate scales like a monster if you know what you're doing. This is why I don't compare them as better or worse. I compare them as complementary. Real estate gets me wealthy. Dividends keep me stable. Real estate builds equity. Dividends build liquidity. Real estate is long-term. Dividends smooth the short-term. Together, they create a lifestyle of income, balance, and freedom. Now let's talk taxes. Rental income has depreciation, interest deductions, real estate professional status, and forced equity growth. Dividends don't have those superpowers, but they do have advantages. Qualified dividends are taxed lower than ordinary income, and dividend income can be sheltered inside IRAs or Roths. When you combine the two, you get tax write-offs plus tax-efficient liquidity, a powerful combination. Here's how I allocate. For every dollar I put into real estate, I try to put 25 to 50 cents into dividend-producing investments. That ratio ensures I have liquidity for repairs, cash for deals, backup income, diversification, and a balanced risk profile. Wealthy investors don't go 100% into one asset. They blend assets that strengthen each other. If you want to build your own dividend income stream, start simple. Step 1. Invest $100 a week. Step 2. Buy income-driven ETFs for immediate cash flow. Step 3. Add dividend growth stocks for long-term raises. Step 4. Add REITs for diversification. Step 5. Sprinkle in covered call ETFs for boosted yield. Step 6. Reinvest dividends for the first year or two. Step 7. Eventually start taking a portion as income. Step 8. Maintain balance between real estate and dividend income. This blueprint gives you short-term income, long-term appreciation, risk hedging, tax efficiency, liquidity, diversification, and financial freedom. Real estate built my wealth. Dividends protect it. Rentals give me cash flow. Dividends stabilize it. Real estate gives me equity. Dividends give me liquidity. Together, they build a life where cash flow comes from everywhere. If you want to build a $2,400 per month dividend stream like I did, start small, stay consistent, automate your buys, reinvest relentlessly, and balance your portfolio between rental income and dividends. The goal isn't to pick the best asset. The goal is to build a life where money flows in from multiple directions every single month. Follow the finance chart for more real numbers, real strategies, and real cash flow blueprints.